Hi everyone, hope you're doing well. Welcome to the most popular video series that I do on the YouTube channel, which is the Stocks I'm Buying April 2025 edition. So today I'm going to go through all the US stocks I bought and sold between the 1st of March to the 1st of April, and every single move that I made in the stock market is on this video series. It is the way that I keep up transparency, where you can see every single move that I'm making. Other YouTubers sometimes won't tell you what they're buying until it's successful and they go, oh look, I'm a genius. And at the same time, they won't tell you what they're buying and then it doesn't work out and they hide that one in the background so you guys don't notice. We don't do that over here. On here, we do every single move I make in the stock market or on these videos. So you can go back to previous video series. So for example, April 2022, and you'll be able to see what stocks I was buying then, and you'll see if it worked out or not. So I hope you enjoyed the video. Everything here is for a 2 to 5 year long-term hold, and every stock I buy is to try and make 100% return on that stock. Apart from that, let's get started. Now, just before I go through the 6 stocks I bought and the 1 stock I did take a little bit of a sell on, a bit of a trim, just to let you know, if you do want to join the Patreon, link is in the description. So on there, you get to see what I'm buying and selling in real time. So as you've probably seen, the market has been very choppy since the 1st of April, and I have been very aggressive in that time frame, buying more stocks than what are even featured on today's video. So if you do want to see my live buy and sell alerts, that's the place to be. Otherwise, you'll have to wait until the end of the month to see what I bought during that period of time. But if you do join, you're supporting the channel. It's £6 a month. Make sure you do it through the web browser, not through the Apple iPhone, because if you do, you'll get charged an extra 30%. So save yourself a bit of money. And on there right now, we've just done the US stock market portfolio. You can see how my US stock portfolio is doing, and also my UK portfolio, and you get to see how my UK portfolio is doing. As well as that, if you are new to investing and you do want to get started, now's not a bad time considering we are in a stock market crash. Those are always the best times to start investing. Join through the link in the description for Trading 212. That's personally the investing platform that I use. I think it's the best one out there in the UK right now. And if you do join, you can get a free fractional share worth up to £100. So link for that is in the description. Starting off with number 1. So the number 1 is Google. Google is, in my opinion, the best stock right now on the stock market. It is the stock that I want to be my largest position. It's currently my 3rd largest position. I would like it to come number 1. For it to come to number 1, it would have to stay probably around these sort of levels for the next 6 months. And if it does, I'd be able to build up that position into Google, and that would be very good in my opinion for my portfolio. So right now you do get a small dividend. There is a P ratio of 20, which already is incredible because Google, in my opinion, is the best company in the world. And to be getting it at 20 times earnings, the average market valuation, you are getting it below the S&P's current valuation. That should not be happening. And if you look at Google, it's been a great performer, even with the little dip that it's currently having on here. And it's not very often you're able to pick Google up on a 20% dip, and that has put it to very attractive levels. Now, Google own many brands. I think sometimes people just get caught up in thinking about Google search engine. If you step back and you actually look at all the brands they own, you are picking up very diverse and significant brands here, whether it be the Google search, whether it be YouTube, that you're probably watching this on here, unless you're watching the clips on TikTok. You're getting the likes of Google Cloud, for example, Google Chrome. There's a lot of businesses under Google's umbrella. Now, latest earnings were actually pretty good, even though the stock dipped quite a bit off their latest earnings. They had a EPS beat and revenue came in at 11.8%, which is obviously very nice growth. If you look at Google right now, Google is currently 17 times forward earnings. On 2026 numbers, 15 times forward earnings. In my opinion, you should not be getting Google at these sort of levels. This is the lowest that Google has been since the 2022 stock market dip, and we saw how much it rallied up from that time point there. And it is the lowest it's been since 2012. Normally, this company trades around about 25 to 30 times earnings. In my opinion, that's where it should be valued. Now, if you look at the growth of the company, there's a lot of growth here. Obviously, you've got the Google search, YouTube ads, Google network, Google advertising, but the big growth driver for them is Google Cloud. This is growing profit rapidly, and it's currently one of the fastest growing parts of the platform. Obviously as well, you got the other bets, which is growing quite well at the moment, because coming under that other bets is Waymo. This is a major wild card you are getting with this stock. Some of the stocks are getting valued at 300, 400 billion because of robo-taxis. With Google, in my opinion, you're getting that free bet into those robo-taxis right now. And in my opinion, the most developed robo-taxi out there. And you are getting it for 20 times earnings as well. This is the thing with Google. You're getting all these kind of free bets inside this business, as well as this well-established business at the moment, all for an attractive valuation right now. Now, there's a lot of talk about AI, and I apologize, the best slide I could get for this was an article of Reddit on Gemini. But I always see a lot of people saying, well, Google AI is going to disrupt him. And I totally disagree. I think AI will be a major driver for Google. I think their actual AI products are actually very good, the likes of Gemini, for example. And I would say Google and Gemini are also the two AI products right now that I actually use myself. Those are the two that I actually think are the best products out there to use at the moment. And as well as that, when you're a company like Google, when you look at the financials that Google have right now, they are growing revenue at good rates, but also the amount of profit. You know, this company is throwing off at the end of this year, 108 billion of profit every single year. With that, you can do dividends, you can do the share buybacks, but you have 108 billion to play with. Like, the things you can use for that are incredible. Imagine the amount of companies in the world that you can just go buy out with a year's profit. And this is why that they are able to just put all this cash into their other bets. And if one of them, if they do 50 other bets and one of them comes a company that generates 100 billion in revenue a year, it's going to be successful for them. And obviously as well, it leads to an absolute amazing balance sheet where the debt is very minimal, and as well as that, they sit on a very healthy cash pile. So for me, Google is the best company in the world, and it's not often you get it at this sort of valuation. I am buying this one heavy. I do want it to come my largest position, so we'll see what happens there. Number 2, DraftKings. We are back buying DraftKings. This is like a step back into 2022. I have not really been actively buying DraftKings for a long time, but I am actively buying DraftKings now. So the last time I was really going heavy on DraftKings was like this period here, but I have started to go back quite heavy into DraftKings recently. The reason why, the share price for the last year hasn't really done anything. In fact, it's down. And especially at the moment, only about a month ago, I was selling DraftKings at nearly 100% gain of profit. And during that time frame, the stock has fallen quite rapidly. It was down at 41%, 40% at one point, but it has had a bit of a bounce up. I think this is very unfair considering the financials that DraftKings has done. Now, first of all, what do DraftKings do? They are an online sports betting and iGaming product that is launched in the US. So for us guys in the UK, it sounds crazy, but in the US, it was only around about 7-8 years ago that online sports betting was allowed in the US, and iGaming, like the online slots, was allowed in the US. It's crazy to us in the UK because we've had it for so long, it's so mature here, but it only just got allowed in the US. Now, state by state, they are starting to allow online sports betting and online iGaming, but you think about that being launched in the US and it's only been done in the last few years, you imagine how much growth that's going to have for years. And also, as these states individually slowly come online year by year by year, imagine the growth that's going to be in there for the US. It's going to be a major market. And one of the big things that I've been focusing on the last downturn is by buying stocks that are in TAMs, total addressable markets, that have the opportunity to make mega money in the next 5-10 years. And for me, one of the clearest markets that's going to have major growth in the next few years is the online sports betting and the iGaming in the US. And if you look here, this is from their investor presentation, and look at how much this is scaling up from where we were at. So the kind of the launch in like 2018 and look at how fast we've been scaling up. And obviously this is up to 2023 and the latest numbers are even better. Now this once again is a bit of an old slide about where we are currently at, but you'll be able to see the states that currently have the online sports betting, which are in the green, and you'll be able to see also the orange ones that have the iGaming. So there's still quite a good chunk of the online sports betting to go. I think we're currently at 54%. iGaming has major drivers because only 5 states currently have iGaming. Now what's going to happen is all these states are going to realize the tax that they can make on this online sports betting, so they will eventually allow online sports betting. The next thing that will happen in the next few years is iGaming will be allowed in more and more of these states, because they'll go, hold on, we're making all this money from online sports betting, why don't we also allow online iGaming as well, and we can make more taxes from them. And actually, when you look at a lot of these companies like DraftKings, they actually make more profit from the iGaming part of the business. So when this is allowed more and more, it's actually going to only help the profit as well from DraftKings, which is great. Now, the thing that I didn't really realize was going to happen is that DraftKings would end up in a duopoly in this market. So between DraftKings and Flutter, or FanDuel, Flutter's the parent company of FanDuel, they currently have 80% of the US market. And you can see here they're projecting that it can reach 29 billion in 2030. I never thought this was going to happen when I invested into this business. This is what has made me even more bullish on this business, is I always thought this would be a bit more like the UK. It's a little bit more of a fragmented market where there's, 5 or 6 big players in here. The fact that DraftKings and FanDuel have a duopoly over this TAM for the next 5-10 years is going to be incredible. So we look at some of the success that some of these companies have had in the UK. You imagine now the US is such a bigger market, but also it's going to be a duopoly. That's going to be very good for DraftKings. We've seen competition come in with the likes of Disney. I have no idea why Disney partnered with ESPN, but they did. And you can see that them guys are absolutely struggling massive. I remember when this happened and people were panicking. I remember getting a lot of messages at the time saying, oh, but Disney and ESPN are coming in now. This is going to be major competition for someone like DraftKings. And they knocked out the competition. Someone like Fanatics, they tried launching the sportsbook. Once again, struggling as well for them. So DraftKings just keeps knocking off the competition. Look at the revenue growth here. Fantastic revenue growth. And I'd even say these forecasts here are probably a little bit sandbagged as well. Net profit, one thing I've always heard about this company is, they lose a lot of money. But people don't realise it takes time for these states. Every time you keep launching these states that they're currently launching going forward, it takes a good 2 or 3 years for the payback for them to actually generate profit. Now, when you launch so many states at once, it eats up your profit. But now, because they're over 50% in the US on sportsbook, what that now is happening is it's now maturing and they're actually starting to achieve that profitability. And that profitability is also going to be achieved very, very quickly. Probably quicker than what people realize. You look at the losses, 1.5, down to 1.3, down to 800, down to 500 million. That also had a bigger impact because of the outcomes were very strong for the customers as well. So if it wasn't for the strong outcomes, that would have been even smaller. This year, we are expected to turn the corner on profitability and we are supposed to become profitable. We're still insane amounts of revenue growth, and 2026 as well. And if you look at 2025 numbers, puts you down at a P of 68. If you look at 2026 numbers, you're down at a P of 23. Now, realistically, if they do get to 2026, and I still think, at the moment, I think this growth is a little bit slow for what they will actually do. And look at how fast that profitability is scaling up as well. Very quickly, 23 times earnings for this business is going to look incredibly cheap. I would say the stock has the potential to 3x in the next 5 years. And that's why I am starting to really add back into my DraftKings position. That moves me on to number 3, which is gambling.com. So staying in the same sort of area, I am adding into this position here. A stock that IPO'd in 2021, but realistically the share price hasn't done much. Well, it is up 47%, but probably not as good as what the financials have been on this stock. So what is gambling.com? Well, if you just watch the DraftKings part, it's a bit similar to DraftKings. They are a leading provider of player acquisition services for online casinos and online sports sports books. So what the best way to do is, I've actually got a slide somewhere. We'll come on to that slide in a second. But they are not a gambling product. It's more of a referral site. So the best way to imagine it is someone like a booking.com. So you want to go have a stay and you're looking for hotels, and you go on booking.com, and then it will give you the best price, and then it refers you to that hotel and whatever area you're looking at. Gambling.com is exactly the same. So you're looking for maybe to do a certain bet on something, or you're looking for a new sports book. You go on gambling.com and they have all the offers on for which is the best offer at the moment. And then they refer you to that site, whether it be like the DraftKings or FanDuel, for example. Now, they've had a lot of success, as you can see here. They have had very good revenue growth, very good net income growth, as you can see here. 500 full-time employees, and a lot of clients generated, as you can see, for these sites. And you can see the historic revenue growth right there. Looking at adjusted EBITDA, great track record, great stairs going upwards, as you can see here. Free cash flow as well. These are all the customers. So like we said before, you've got the big ones in the US, which is key, with the likes of DraftKings and the likes of FanDuel, for example. And the big thing they're going to have at the moment is the growth into the US. That's going to be a major growth driver for them, as we've just seen with the likes of DraftKings. That's going to be a major growing country for them at the moment. And as well as that, some other areas that are going to be very good for them is the likes of the launches into the likes of Canada, for example. Latin America, Brazil and Mexico are great growth drivers for them going forward. You can see here that North America has been a fast growing area for them at the moment and will be the biggest area for them, the number one priority. Europe still has some potential though, as well, like we talked about, Latin America is a new fast growing area for them. They have been the most successful company in this space, referring a lot of these clients to some of these sports betting platforms. You can see here that compared to the other competition in here, they have had the fastest organic growth rates here. So obviously excluding the likes of acquisitions. If you look at the growth in, like we just shown with the TAM before, on global online gambling is growing at a 12% CAGR, which is still pretty good growth because obviously that includes a lot of mature markets. The US, which we've just talked with DraftKings, and obviously with this one as well, is the major growth driver for them going forward because that's expected to grow at a CAGR of 28%, which is massive. So if we zoom out and look at the financials, you'll be able to see here the very good growth that they have had from a revenue point of view. The profit as well is very nice, great profit margins, and that is expected to continue going forward. As you would expect with a company of these levels of profitability, they do have a cracking balance sheet, only 18% debt to equity, a nice cash balance as well, and obviously generating good amounts of cash as well. With that cash, they can do acquisitions, which sometimes they do by buying up some of the smaller competition in this sort of area and consolidating it, or they have the option to potentially do share buybacks going forward. And if we look at Stockopedia, as you can see here, you have the revenue growth growing up nicely, the net profit as well going up nicely, puts it around about 11 times forward earnings on 2025 numbers, and on 2026 numbers, 9 times earnings. 9 times earnings for a company growing at these sort of levels, in my opinion, is not a correct valuation. I think the share price should be about double from where it is right now. So I am buying into the stock. And if you do want to join Stockopedia, there is a link in the description, and I think that discount code gives you either 20 or 25% off. They've just upped it, guys. So if you do want to join, links in the description. Moving on to number 4, which is AMD, or Advanced Money Destroyer. So it has had a tough time at the moment. The stock has been going down more and more. This is quite a recent investment into my portfolio. So I started buying probably around the $110-ish range, I think. But since even I've started buying it, the stock has gone lower, 1 point down 32%. But it has had a bit of a bounce up, but still down a fair bit. But I keep averaging into AMD. Historically, being a fantastic performer in the stock market, but you can see the dip that it's currently on at the moment. If you bought at the top, you're down 53%, which is not nice. But obviously, I didn't buy at the top. I'm quite a new shareholder, so hey, it's not a big issue for me at the moment. Now, what do AMD do? So they're a semiconductor producer. They do data center, client, gaming, and embedded. Now, if you look at the revenue growth has started to bounce back nicely at 24% year over year. This revenue growth has been speeding up quarter after quarter after quarter. During the last period of like 2023, 2024. As you can see, the share price stagnated. What happened with the company is they fell a bit behind on some of their new products and they weren't able to capitalize on the AI demand. So compare someone to like Nvidia, you'll see Nvidia has performed a lot better because their products were a lot better. AMD fell behind, but in my opinion, they are starting to catch up now. And that is clear when you look at the growth. Some of their new products are actually very good. You can look here that the gross margins are expanding as well as they are scaling up, scale of efficiency coming on. EPS is also joining them on a non-GAAP basis. It's important to say that because on a GAAP basis, there is a one-time tax provision going on there. And if we do look at some like the new products, for example, we have like the MI400 that's going to be coming up in 2026, which will once again, hopefully help them compete with the AI space that's currently going up at the moment. But if we look at the revenue growth, for example, we are expecting another speed up in this quarter of nearly 29% growth. And overall for the current year, we're expecting 23% growth and next year, 20% growth after that. If you look at the EPS, you'll be able to see that the EPS is ramping up from 0.62 to 0.94 in the next quarter. And overall, as we look at 2025 numbers, great increase on the EPS. And that will mean that AMD will be around about 20 times earnings at the end of the year. And if we look at 2026 numbers, 15 times earnings, which for a company that is about to grow at 20+%, in my opinion, is a little bit cheap. I personally think this company will be trading at like 30 times earnings-ish, which is assuming a little bit of a premium to the market, but they are doing premium growth, so I would expect that to happen. So yeah, I like AMD at the moment. Moving on to stock number 5, which is Enphase Energy. So this is a stock that has had a big dip at the moment since 2022, down 84%. Wow. That has taken it back to the levels it was at all the way back into, it's even before the CV times. Yeah, we're going back to like the likes of May 2020. So anything in the last 5 years has been wiped out on the share price. Now, like I said, once again, this is a newer position for me. I only started buying this at the start of this year. So I am down a little bit. I am down around about 15% on this position. So I'm buying this stock at these sort of levels thinking that this is the bottom for the stock or near where the bottom for the stock is, and it will start turning around going forward. Now, like I said to you before, when I was buying someone like a DraftKings, I want to buy something in the next 5 years. I look at the area, the market they're in, and I go, you know what, in the next 10 years, this industry is going to be worth more. And I look at Enphase, they're in the solar market space. Solar power, in my opinion, is going to grow in the next 10 years. We need more energy. We need more electricity with the likes of the AI that's going on. Everything's going more electrical as well as that. And obviously, everyone wants to be a little bit more green as well, So when we look at the CAGR of this space here, the CAGR of the global solar power energy is to grow around about 15%, which is a pretty decent growth number. When we look at what they do, their main product is what we call a microinverter. So what they actually do is they manufacture this part here. This part goes on these solar panels, and they all individually go on the solar panels. And this is a lot different to what historically happened with solar power. So previously, what we had was the string inverters. So what would happen is the string inverter, all of these panels would go through the string inverter, and if one of the so the string inverter was only able to get the power from the lowest performing solar panel. So if you had a solar panel that broke, you would have no power. If you had a solar panel that was in the shade, you would have less power. If it had, some dirt on it, you would have less power. It would affect your whole unit. That's not what you want to have. With the microinverters, they all individually go on the solar panel. So if you have one panel that is not performing, it doesn't matter. You're still getting all the other solar panels that are doing amazing, bringing you in energy. So if you have the broken one, it doesn't affect you. If it's one's in the shade, doesn't affect you. One is got dirt on it, doesn't affect you. So even though this product is a little bit more expensive, people are willing to pay more for this product because it's more efficient. And then what they're able to do is they're able to put that into some other products that they have. So they have like the batteries that they sell on top, the car chargers that they have on top as well. And with over 606, that's a bad number to put on a website, 666 patents at the moment, they have a bit of security over the best product in this market. The company itself is mostly starting to move to America. So one reason why I think the stock might have gone down is because of the tariff situation at the moment. But I can't believe it's going down because of the tariff situation, because they have already been moving a lot of their manufacturing away from China, and hardly anything comes from China at the moment. A lot of it is manufactured in the North America, which doesn't make sense why the stock is kind of dropping. Revenue wise, it has had a bit of a slowdown, and that is why the stock has been struggling at the moment during this period of time, because a lot of people during this period got solar power because it was cheaper. Interest rates were very low, so when you are installing a product like solar panels, it's quite expensive. People take it on interest. If your interest rate goes up, less people are going to take out the product. So before, interest rates were low, so a lot of people were getting this product. Obviously, interest rates then started to go up, so less people started getting the product, as we can see here. You also had the point of view where energy during this period went expensive. That's always a key catalyst why people go and get solar energy. And basically, since 2022, they've had very hard comps because they had expensive interest rates, and solar then started going, or energy prices then started coming down again. So because of all that, they've had really tough comps for the last kind of 2 years. In my opinion, the tough comps are out of the system now, and that's where we're going to start seeing the likes of Enphase starting to go back up to growth, as we can see, which is forecast this year. Net profit, hopefully get back up to levels that they were doing previously as well, which is obviously really good amounts of profit actually, which will put it on 16 times earnings on this year's numbers and 13 times earnings on 2026 numbers. And you can see the rebound here that is forecast with the revenue and profit. Even during this time frame with this big slump of revenue, they were still at profitability, which is also really impressive for this business. That's obviously why as well they've got a decentish balance sheet, as you can see here, more cash than debt, which is great. Probably also worth pointing out that the CEO did also buy some shares at the $60 range, and also bought some shares here on the 20th of November at the $62 range as well. Because it does make that profit, I hope they do continue to throw some share buybacks off. They did recently announce, well, the last one they announced was in 2023, which was a 1 billion share buyback. Which is obviously a lot, and they do make good amounts of profit, as you can see here. So for example, this year they could do 237 million. That sort of level of buybacks right now on a 6 billion market cap is a big chunk of the market share. So if they can keep doing that, that's obviously really good as well. And that leads me on to number 6, the final stock that I bought, which is a stock called D-Local. So this one is probably the most, Enphase and D-Local were the two riskiest stocks I bought in the last month. This one in particular, I would say, is probably the most risky one on the list. Since I bought it, the stock has had a bit of a tough time. So I started buying this one during 2024. During that time frame, the stock has had a bit of a tough time, as you can see here, but it's still way below where it IPO'd actually in 2021. And it has had a couple of bouncing months, as you can see here. The volatility in this stock is quite significant. So what do D-Local do? So what they are able to do is they allow merchants to connect seamlessly with billions of emerging market users. So an example for this is all these partners they have on the bottom, the likes of Nike, Amazon. So these companies here, they want to sell products in emerging markets. The big growth drivers, these markets that are coming very hot growing e-commerce spaces for them to be in. But obviously when you operate in these sort of spaces, what happens, you have the FX impacts, a lot of currency impacts, and you've got a lot of these companies report in dollars, so then they've got to earn the money in the local currency, convert it to dollars for their reporting. So D-Local helps with that. Also what it helps with is fraud. There is a lot more fraud in some of these emerging markets, and they also help some of these companies operating with currency fraud as well. So this is operating in payment methods in big e-commerce growing markets, which is a very fast growing TAM. What is also quite good about this company is they also have CEO came in about a year and a half ago now, which was from another company I own, which is Mercado Libre. So the CFO came in from Mercado Libre as the CEO, and he did a very good job at Mercado Libre. And this is one of the reasons why I also bought the stock, is because he did such a good job in a previous investment for me. I felt like if he's taking this step into D-Local, he must see big opportunity, and especially being operating as the CFO in another company that operates in this e-commerce emerging market. As operating with Mercado Libre, he must have seen the success with it. And Pedro Ant is hopefully someone that is going to turn this investment into a successful business for me. And it gives, when you ever listen to a D-Local conference call, he does give a lot of good information on the conference call as well. Looking at the company, TPV volume was up 45%, so the total payment volume is just increasing more and more on the company as well, which is great to see. Now in the recent earnings, Africa and Asia were still growing at very good rates, as you can see here, up 67% year over year. However, Latin America was a little bit of a slower growth year on the profit side of them last year. The reason why is because they were impacted by big FX devaluation in Argentina. I'm sure you saw what happened politically in Argentina last year, and to be fair, it looks like Argentina is in a good place once again, and that could be a major tailwind with them going forward, as well as the FX. I think in the next quarter, that's going to be a major tailwind for them, because if you do look at the FX prices for them, a lot of them have gone in their favour. And in fact, Pedro Ant on the last conference call said we've actually had a really good FX period in this quarter so far. And obviously the quarter has now closed, so we'll see if that does show up in the financials. They did also have a repricing with a top merchant in Brazil. So I think it was the number 2 client crossed the threshold where they get charged less than what they were getting charged before, and that did hit them in the financials. A little bit of a concern that there is the ability for that repricing to affect them so much going forward, but worth pointing that one out as well. But hopefully some of these, what have been headwinds for them in the last year, start turning into tailwinds going forward. They have announced a pretty decent share buyback, which was a 200 million share repurchase program in May, which if we do look at the current share price is just short of 10% of the whole market cap, which is obviously pretty good. Even with all the issues that are currently going on, you can see here the company still makes mega amounts of profit, and hopefully them headwinds start going and we start seeing the company go back up to good revenue growth and good profit growth, because previously that is what the company has had. Very good. If we just take free cash flow off, yeah, look at that revenue and profit growth. By the way, if you want to join Simple Wall Street, there's a link in the description, guys, and it gives you I think it's a 30% discount as well, 14-day free trial as well, so you can try the platform out. But you can see here like the revenue growth has been very good, profit growth has been very good. Obviously a little bit of a slowdown recently, but still major amounts of profit, as you can see here. And hopefully when those headwinds have gone, we go back to that growth of revenue, growth of profit. Good balance sheet as well. You can see here on the slight debt on there, but they sit on around about 566 million. So hopefully they can throw a little bit more share buyback in there as well. Right now on 2025 numbers, about 15 times earnings, 2026 numbers, 11 times forward earnings. So yeah, I think this is a stock that I need to add into a little bit more. And that leads me on to the final one today, which was the sell. So I did trim a position during this time frame, and the position I trimmed was Alibaba. I did trim my Alibaba position for around about, I think it was 10% of my holding, for around about a 41% gain. The reason why, the stock just went ballistic. If you look at the stock price, yeah, in a 2-month period, the stock went up 71, went up even more than that, nearly 80%. Yeah, it went ballistic out of nowhere. And even though, in my opinion, Alibaba has been undervalued for a very, very long time, that jump there just seemed a little bit unnatural to me, and I thought I'm going to take a bit of profit off the table there. As well as that, I think it did jump up a little bit to like 17, 18 times earnings, which is, I'd say, about fair for Alibaba. You could make the case that actually, if you look on a forward basis, it's still relatively cheap. But for right now and how long I've held it, you know, we're here to make money, take a bit of profit off the table. And I'm glad I did, because since then the stock has actually fallen. I did actually think about maybe selling a bit more than what I actually did, but I did change my mind. But obviously, you know, it kind of looks a genius in hindsight now, but you know, I didn't know at the time that the trade war would go as how it has done, and that's certainly why the share price has been affected so much. But yeah, I just looked at the share price, looked at the valuation. You know, we're here to make money, take a bit of profit off the table, and I'm glad I did, because the share price has gone lower, and with the profit I have taken, obviously there's plenty of opportunities out there in the market. Obviously these are the stocks that I were buying and selling during the 1st of March to the 1st of April, and during the next 2 weeks, obviously there was even more volatility. And when I do next month's video, there'll be, I think there's going to be like, we're going to be in double digits of stocks. So it's going to be a big one next month. So if you think this was a big one, the next month's video is going to be even longer. So prepare yourself for that one anyway. But well done if you made it all the way to the end. These are long videos, but I hope you enjoyed it. It takes me a while to record it and edit it, so if you could just like it and maybe just share it in one place as well to help it get out there, because these videos do take a good 4 or 5 hours to put together. But I hope you enjoyed it. Hit the like button. If you're new around here and you found it useful, subscribe as well. And apart from that, I'll see you all in a bit.